very good evening. You're watching Commodity First special edition, Eye on OPEC. Tomorrow, of course, the two-day OPEC meet would start. It's the highly anticipated OPEC meet. This is, of course, being scheduled in Vienna, with both the OPEC and non-OPEC producers battling for supply production cuts. The key issue that will be taken up would be whether the countries will agree for a further production cut or not, and if yes, what would be the time frame for the production cut, whether it would be the 6-month or next 9 months. Also, if new countries would be joining the agreement. We've already observed some new countries talking about it. To discuss all of that and more, and what are the factors at play ahead of this crucial juncture for the global commodities market, we have a special lineup of commodity experts from all over the world joining us on the show. Vandana Hari, analyst at Vanda Insights, is right here with us in the studios. Apart from her, Alan Gelder from London would be joining us. Azleen Ahmed from Argus Media Singapore. Kunal Shah will join us right here from our studios in Mumbai to get us a trading view, how Indian traders on the MCX should approach this event. Let's, before we actually go to all our guests and get the view, let's set the context on what exactly is the situation right now with my colleague Mubina joining us on the show. Mubina, tell us what are the factors in play and what's the stage looking like ahead of this important meet?
Well, it's one of the most awaited meetings of 2017, the OPEC and non-OPEC members meeting in Vienna, scheduled on the 24th and 25th of May. Second such meeting wherein they're going to decide on whether to extend the output cuts or even perhaps deepen them. Do remember that back in December, they had decided to cut output in the first half of 2017, though of course some producers did not want to participate because of their individual country and geographical problems. But yes, right now, why is this meeting important? Firstly, the oil market is still in a supply glut. We are seeing US producers pump out oil in big amounts. Inventories have reached record highs, and OPEC wants to keep the inventories near a 5-year average. So what are the outcomes? Well, A, no extension, which is something that the market's not really betting on. Secondly, a 6-month extension, a 9-month extension, a 9-month extension with deeper output cuts, or even with more countries being included. Now, Goldman Sachs says that it's important to extend the output cut by 9 months because it'll help the supply dynamics in the oil market. It'll help keep prices above $57 per barrel and keep the oil market in backwardation, which is important because it will discourage investors from pumping more money to the US shale producers. So yes, 24th, 25th May, the outcome of the meeting will be watched out by investors and market gurus worldwide with bated breath.
Thanks very much for that, Mubina. Vandana, I would like to start our discussion with you. What are your thoughts? In fact, I've been observing some of your tweets as well. Going to this important event, what are your thoughts?
I think 9 months is a foregone conclusion. It was last week that the Saudi and the Russian energy ministers put out a joint statement in which they said they had agreed to recommend a 9-month rollover to March 2018. So I think that's pretty much a given. Yes, there will be some discussion because I think at least a couple of countries have mentioned that perhaps it should be just 6 months. To my mind, 6 months, 9 months really is splitting hair a little bit. Because, it's not like something magical will necessarily happen by March, which won't happen by December. At the end of the day, the market will be watching what impact, if any, these cuts have going forward in the coming months on inventories. I think that will be very closely watched. And the second aspect, of course, is what impact is US oil production. What impact will it have on the US oil production? And I think all of those things will have to be factored in. I don't think OPEC can just say 9 months, same conditions and be done. I think it's going to be an ongoing monitoring and the need to continue tweaking and adapting to how circumstances evolve.
Fair point. In fact, Alan, I would like to come to you at Wood Mackenzie. How do you, look at or analyze the situation also in light of the very weak compliance of earlier agreement? What progress can be made in this OPEC meet in your view?
We've had the expectation that OPEC's cuts would roll over from earlier this year because we've seen very slow drawdown of inventories. We think inventory draw could be quite significant in the second half this year if OPEC rolls over. In terms of the recent news from Saudi and Russia about a potential extension to 9 months, we think it is a bit more than splitting hairs. In terms of Q1 is usually the period when oil demand is weakest. So what OPEC is what Saudi and Russia are trying to do is avoid a precipitous price drop that we're expecting in Q1 18 when volumes return. So our expectation is OPEC is likely to go for a 9-month agreement. The dilemma they face is that'll result in higher prices, greater revenues for themselves, but provide more support to the US tight oil sector. So we're not expecting them to go beyond 9 months because that's committing to something that the US tight oil industry could take significant advantage of. It's something they need to monitor closely. Compliance in this first agreement has been very good. Russia's achieved its 300,000 barrels a day cut. History suggests compliance is poorer during extensions, but they've got a whole technical committee that's much more focused on that. So we're expecting, should they roll over 6 months, 9 months, compliance to be better than normal and more closely observed and publicized.
Azleen, both of our panelists before you believe that the probability is high for a 9-month extension. What are your thoughts at Argus Media? How are you approaching this important event?
Yeah, I mean, we see the same situation, and we agree because we do expect that the ministers will likely agree to an extension at the same levels for 9 months. I guess there's always the prospect that they may decide to deepen the cuts, but that seems to boost oil prices. But I think that it just seems unlikely because a jump in oil prices could encourage even more shale oil to come on stream. So our expectations are that it will be a rollover and it will be 9 months, and that's the signals and the indications that the major producers like Saudi Arabia and Russia have shown. But our view is that if now that OPEC has taken the decision to have a bigger control over the market, it's true. We don't think that they can abandon that position. It's most likely OPEC will have to continue to cut its output into 2018, possibly into second half of 2018. So I agree with Vandana. I don't think that it's just going to end in March 2018. I think that OPEC will need to take control of the market and continue to cut if they want to prevent an industry stock build that we saw last year and prices from collapsing, especially in 2018 when shale oil is expected to increase even more than this year. Right.
Azleen, stay with us. In fact, I must read out the flashes which are coming in right now on our screens for the benefit of all our panelists. The news coming in that OPEC committee has recommended a 9-month oil cut extension. This is in line with all our 3 panelists before telling that what could be the likelihood. But let me also read out to you that this is the joint committee of ministers from the OPEC and non-OPEC countries, which are also meeting today ahead of the official OPEC meet, which starts tomorrow. But before that, I would also like to understand the significance of this particular flash which has come in. Vandana, the official meet is tomorrow, but this is just perhaps a warming up meet which all these joint committee members are having today. How do you read this?
Yeah, so there are a few committees that work. These are essentially experts drawn from within the OPEC member countries who meet prior to the ministers, the main meeting. And they have this unenviable task of going through all the detailed data, how is supply looking, demand looking, stocks and so on. To my mind, when we had the 2 ministers, Russia and Saudi Arabia as respectively the de facto leaders of the non-OPEC and the OPEC group respectively in these cuts, once they agreed that it should be 9 months, I think it was pretty much that's what it looks like it's going to be. I think more significantly here, it's the messaging. For OPEC, that's always been the case, especially since last year. So what they're trying to say here, and if you recall also the joint statement that they put out, they said, we will do whatever needs to be done. to make sure that markets rebalance. And I think so it's all pretty much a part of the messaging that they're saying we are willing to extend for 9 months, because for the most part, the market had assumed that if a rollover happens, it's likely going to be for 6 months. So it's more psychological and messaging to the market, really.
Fair point. In fact, in a way, this entire OPEC meet, whatever you call it, has already started today, because the committees have started to meet. This particular committee, the two important members of this committee are Kuwaiti oil minister and Russian oil minister, and they are taking stock of how the adherence has been in the last couple of months to the agreement reached upon last time round, and what is the stance right now. So this is important from a messaging point of view. That's what Vandana is saying. But let's talk about the trading angle, Kunal. You look at international crude prices as well as the rates on the domestic traders, the MCX rates. Talk to us, what are the chart patterns telling you both on the short term, near term, given how last couple of weeks have been? And you also indicating earlier that perhaps this meat is already in the price. Explain your stance.
Well, the overall view on oil is bullish. With whatever is going on right now, oil prices are likely to move up, and by the end of this year, we are going to see Brent somewhere at $60, and WTI for the same reason has to be somewhere at 56, 57. The second half looks more bullish. Here, the major reason why oil prices collapsed was the rapid rise in US oil production. US oil production, which tested almost 9.4 million barrels, was expected to test those levels by December. But unfortunately, that has been met by May. And that is one of the major reasons why oil prices have dropped in the second quarter of this year. Now going forward, I expect that US oil production, the growth will slow down. So for the rest 6 months, I'm not expecting more than 2 to 3 lakh barrels of incremental demand growth from US. And this year, the demand for oil is likely to be somewhere between 1.4 to 1.45 million barrels. So demand growth is likely to remain robust. And with OPEC, whatever it is doing, it is definitely going to cause a spurt in oil prices. But oil prices have already risen from $45 to 51, 51.50. So tomorrow, maybe after the meeting, another $1 or $2 surge we can expect in oil prices. But with a humongous rise recently, I think most of the positive news have been already priced in. So in tomorrow's or day after tomorrow's spike, traders should book profits, wait for another profit taking, and re-enter for the $60 target for the rest of the year.
Fair point, Kunal. In fact, that's the 1 year graph which is coming on the screen right now for crude oil. It does show that there was a fall after the November meet, and then there was a rebound. And ahead of this meet as well, there's a sharp rebound. Though the full 1 year graph is negative 4%. Vandana, how do you read the point which Kunal read about US going ahead and raising production much faster than the anticipated for the full year? By December, the numbers achieved already by May?
Yeah, it's a huge wild card to my mind. The only variable that OPEC can't completely factor in and can't do anything about. So yes, as Kunal just pointed out, I think these are pretty startling numbers. If you just compare from the start of this year alone, US oil production has gone up by nearly 500,000 barrels per day. If you compare with the trough of 2016, it's already up 800,000 barrels per day. We get data from the EIA, the US Energy Information Administration. I think they have been very consistently a bit conservative when it comes to projecting figures. So it's and they have been consistently revising upward their estimates as well. And I see a whole kind of consensus emerging now around, possibly by the end of this year, we could have US production nearly up to maybe 1 million barrels per day more than what it was in 2016. Now, let's not forget 2016 was the first year in nearly 6-7 years of the shale boom that US production actually went down year on year by nearly 800,000 barrels per day. So this year looks like they're going to reverse that and go above.
Mm-hmm. Alan, I would like your reaction on, in this light and in this now the commentary which is coming in from the joint committee which was set to meet even on the eve of OPEC meet. Some commentary from Donald Trump seems to be suggesting that the US in a very long time is coming now in the mood to trim their strategic oil reserves, which are humongous and never been touched before. And now some indication from their office that they are wanting to trim it in the open market. Did you gather that news point, and how do you analyze it? What's the possibility of that, and how would it impact the overall crude oil market globally if indeed that were to happen?
The understanding we have is from the news that we've seen approximately halving their strategic petroleum reserve, but over a 10-year sort of time frame. So it's something, if you put that as a prorated assessment, it's something of the order of about 100,000 barrels a day, which directionally is not particularly large. The challenge is the timing is particularly poor. If that was to happen soon, in terms of OPEC is cutting production to get global inventories to fall, at a time that the US may well be releasing barrels onto the market. So we understand the rationale in terms of if you look in terms of net imports from the US, we've got strongly growing production, domestic production, reasonably flat runs, slowly growing demand. So the need for very high strategic stocks in terms of days cover is diminishing. Timing about selling that reserve really not helpful to OPEC and the messaging it has in what it's doing about its meeting now. But if it is over an extended period and starts to take place, not immediately, but in some coming months, it shouldn't be too significant. However, timing is not the best.
Fair point. So what's your analysis at Wood Mackenzie? Next 6 to 12 month period, how do you see oil prices range, and what would be the key monitorables for the factors which will impact the prices?
No, okay. What we've got on the basis of a 6 to 9 month extension, what we have is crude prices in Brent terms rising to high 50s, 58, sort of towards the end of the year. We then have them coming off a little bit because oil demand in Q1 is usually, that's the weakest quarter. So then our oil price forecast dips a little bit and then stay reasonably stable through the first half of 2018. So the impact of extending the cuts is stronger oil prices. The dilemma OPEC has, because we've run a case of looking at the potential outcome if the cuts were extended throughout 2018. If that happens, then it's distinctly possible that US tight oil growth during 2018 is similar to global demand growth at around 1 million barrels a day, in which case that's not great for OPEC in terms of OPEC and its market share. So we're positive for the oil price trajectory for the next 6 months. Then we'll get a Q1 fall, not such a large drop associated with Q1 activity. But there's many uncertainties. Q1 oil demand growth this year was very weak. The agreements do not include Libya and Nigeria. They could have material changes in supply in the shorter term. So there's many things to watch. Oil demand growth in Asia, US gasoline demand and summer demand profile, US inventories, and then what's happening in countries, Libya, Nigeria, in addition to the changing rig count in the US and the activity and cost inflation we see in the Permian Basin.
Azleen, two Middle Eastern producers, Iraq and Saudi Arabia, different sizes. Saudi Arabia clearly is backing the 9-month extension. But do you think the way Iraq is trying to become an obstacle, backing the 6-month extension? In fact, also I would like to understand the big point of Saudi Aramco IPO which is planned. That would get a big boost if prices remain on the higher side. How are you analyzing the situation, this particular situation? Azleen, can you hear me?
Yeah. Well, I think that with Saudi Arabia and Iraq, it's possible that Saudi Arabia is very keen to keep to maintain the OPEC control. So it is possible that Saudi Arabia will continue to shoulder a lot of the OPEC cuts, even going to the second half of this year and early 2018, because they do want to keep the message that OPEC is in control of the oil industry. So Iraq has said that it's only thinking of a 6 month, but it will probably toe the line and agree if all the other OPEC producers decide on a 9-month extension. With the Saudi IPO, I haven't really got a good view of that, but Saudi Arabia, they would want to have a stronger oil market when they do the IPO. So I guess it will be beneficial for them if oil prices are stronger next year when they plan the IPO than it is this year. But I mean that's about all that I can comment on the IPO.
Kunal, very quickly, what levels to watch out for over the next couple of weeks on the charts?
Well, I think for WTI, I think 54, 55 looks toppish for the time being, and whatever rally you see in day or tomorrow, I think those are the rally one should take profits, because markets have discounted this event well in advance. Prices are up by almost $6, so another $1 or $2, I think one should book profits. Vandana,
I'll let you have the last word. What are the pricing levels or band you're watching out for next couple of weeks?
I think 50 to the high 50s is par for the course for the next few months. I would say probably a slight upward bias initially because as expected and as the IEA has indicated, if inventories start draining, that will give a major psychological boost and a sentiment boost to the markets. I think after that, of course, attention will continue to remain on what US production is doing, but as I expect higher prices are going to give a bigger boost to US production. So by the end of the year, you could probably see prices starting to come back down again. And that's when OPEC will probably have to confront the question again, what to do next.
All right, ladies and gentlemen, all our panelists, thank you so much for joining us on this special telecast of OPEC meet, which is in focus for tomorrow. Thanks very much for watching. Hope you enjoyed the show.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.